Today in InvestTalk, we answer the question, why are mortgage rates going up after the Fed rate cut? We also cover the market's moves for today. I answer questions about IBM, Chewy, Newmont mining, and more. And at the end, I look at if a soft landing or no landing scenario is more likely.
This is InvestTalk. Independent thinking, shared success.
Now, my focus point today concerns this headline. Mortgage rates were supposed to come down. Instead, they are rising. I get this question all the time. Why are rates up? Well, it's because the Fed doesn't directly control rates. Okay, more indirectly. And the average 30-year mortgage rate has increased to nearly 7%, which is nearly 100 basis points higher than it was back in, mid-September. Mortgage News Daily had the average mortgage rate at 6.11%. Today, it has it at a dead even 7%. Okay, so you're talking about nearly 100 basis point increase when the Fed is just cut rates 50 basis points. So a lot of people are going, where is the beef? What's going on here? Now, mortgage rates follow not the Fed funds rate. Remember, that's what the Fed, when they're raising and cutting interest rates, that's what they are impacting, the Fed funds rate. But the mortgage rate follows a different number, which is the 10-year Treasury rate. And since that announcement of cutting 50 basis points, the long end of the curve, the 10-year and beyond, that has actually been rising. Why? Because inflation expectations are rising. Economic data also has come in a bit stronger than had been expected. And so the Fed, so the market had priced in a more aggressive Fed policy or Fed easing cycle, and that's kind of come off a bit. And that those two reasons are why you're seeing rates rise, along with, you could say, a third reason, which is the supply of treasuries as well. And so you're going to get an announcement, I think it's this week, the Treasury refunding announcement of how many bonds they need to issue for the fourth quarter. Are they going to issue more short-term or long-term, et cetera? And that will be important as well, and where the 10-year Treasury goes. Now, in addition to the 10-year Treasury, you have mortgage lenders needing to cover their costs to make a profit. So they add some sort of additional rate on top of that. And so mortgage lenders have been struggling as of late because of lower volume. And so a lot of times they need to up their spread to maintain their business, as well as the Fed has been trimming mortgage-backed securities from their balance sheet, which means more private lenders are having to come in and finance the mortgage market as opposed to the Fed, and they also want a bigger spread. So all of these factors means that higher mortgage rates are relatively here to stay. Now, what does it mean for you as a buyer? Well, the first thing you have to know is the market is becoming more balanced, okay? And that you're not going to get back to 3 or 4%. Mortgage rates most likely in the 6 range, I think is what you should expect. 5.5 maybe you get to 5, but probably 5.5 to 6.5, maybe 7% in that range, right? 7% where we're at now is kind of the range you're probably going to see the market. And you shouldn't just tie yourself to what the mortgage rate is doing. You should buy a house that you can afford. Maybe you can refinance in the future, but it's really all about finding things that check your boxes and so that you're going to want to hold for many years into the future. And that's what you have to think about. Don't just try to time the mortgage rate.
We hope you enjoyed this video.
Please consider liking and subscribing so you can stay updated with our latest content. Let's take a quick look at the market today. It was a decidedly positive day, mainly on the small cap value side, up 1.3% there. Large caps overall were kind of a mixed bag. Large cap growth was basically flat, only up 1 basis point there. The DJT, the Trump media, that was up pretty big. Continued kind of push towards the Trump trade, that Trump will win the election, that continues to be priced into markets slowly. Now, still could be wrong, but that's at least what markets are thinking at the current time. Let's see, what were some other big movers? Tesla down about 2.4%, Nvidia down almost 1%. Those are the big movers, the mega caps. Ford was up nearly 3%. Let's see, any big losers? Yeah, no real big losers of notes. And yeah, that was kind of the market day. Really a mixed bag. We have the big jobs number overall for Friday. That comes out. I think we also have an inflation number, if I remember correctly. Let me pull up my economic calendar. I have that here. Yeah, tomorrow we have Case-Shiller Home Index as well as jobs openings, so JOLTS. So that'll give us a little picture. One data point for the jobs number. We also have the ADP jobs number on Wednesday, so that'll be interesting. Pending home sales reports as well as total vehicles sold on Thursday or on Wednesday. Thursday we have the core PCE, the PCE number, and that's a number that the Fed mainly looks at when it's thinking about inflation. So that will be closely watched. And we also have personal income and personal expenditures. And then lastly, on Friday, once again, we have the total farm payrolls for the month of October. So that will be the economic data that we will see throughout the week. And then next week, the election. We are almost a week away. Tomorrow will be 1 week until the election. And we know that's likely to throw some volatility into markets. So we'll be watching that.
Hi guys, this is Matthew. I wanted to ask you about a stock called Chewy, CHWY. I picked up a position on this when it was down below 20 late last year and earlier this year. And recently it's been kind of bouncing between 27 and up to 30. And I'm curious to get your thoughts on its likelihood of hitting that 30 or 30 range or up a little bit above it. Appreciate your feedback and love the show. Thanks, guys.
All right, looking at Chewy, and this is an online retailer in the pet supply business. And this is a company that's had a lot of promise. It's been around for a while now. Let's see, when did it IPO? Let me go to a monthly chart. Okay, so that was back in 2019. It went IPO right around $35 per share or so, dipped a little bit short term, and then rallied all the way to $110 per share, kind of when everybody, in the midst of COVID, everybody buying online, buying new pets, etc. And so there was a lot of pull forward of demand. But since then, the stock has really suffered. It hit a recent low of in the mid-teens. Now it bounced up to $26.80 today. But overall, the technicals are just not very good. Yeah, it's had a little bit of a bounce, but it's not changing the longer-term trajectory of lower highs and lower lows. So that's my main issue. Now, it is a profitable business. They've gone from losing money in 2022 to 53 cents in profits in 23, 68 cents in fiscal year 24, and then 80 cents expected this year in fiscal 25. Okay, so earnings are continuing to go higher, but the earnings are also supposed to fall 39% in the following year, 2026. So that's a bit of a worry there. I know they've been trying to expand internationally and they're trying to grow the business, and they have a good balance sheet. That's good. Problem is that they still trade at relatively high multiples, and they did buy back some shares recently, but now they're issuing more shares again. So that worries me a bit. Their free cash flow is positive. That's good. Or $258 million on about a $10 billion enterprise value. You're talking about a 2.5% free cash flow yield. Price to sales ratio is only about 1. That's pretty good. But enterprise value to EBIT is around 43, forward around 19. You know, that's okay. It's still a bit expensive, and the technicals just to me aren't there. So that's what worries me here is the potential fall in earnings in the next couple of years, as well as the technicals have not improved enough. The fundamentals have not improved enough. And I think they still have a lot of competition from Amazon that they're struggling to compete with. So overall, it's always been a name that's been on my radar, but just hasn't risen to the level that I really want to buy the name. So I'm still passing on Chewy. Now let's head over to a live call. Dan from Walnut Creek asking about IBM.
Hey there, Justin. Thanks for taking my call today.
Of course.
I got a question. I own a pretty small portion of my portfolio is in IBM, probably about 1% or so, and I'm up about 52%. Mm-hmm. I'm wondering what you think about what it looks like for the future for IBM.
Well, IBM's been struggling for some years to transition to the cloud, and but they've, what's interesting is they were in the AI race long ago with Watson. IBM Watson famously competed on Jeopardy, and so they've been in this game for a while. So in some ways, they have a little bit of leg up historically. But they still have issues with the cloud and people moving off of their business. Look at their earnings, only supposed to be up 6% next year, 5% the year after. They do have a lot of debt on their balance sheet. And this recent earnings announcement, like you said, it's reacted poorly. It did hit a high recently of about $237 per share. Now we're down to $212 and change at the close today. And it just closed for the second day in a row below the 50-day moving average. That's not good on a weekly basis. It also had a big reversal last week. And I would frankly sell it. I don't think IBM has the capabilities to really pivot consistently to the new trends in technology. I think they're still saddled by their legacy businesses, and they've made some acquisitions to try to keep up. I think Red Hat was the big one, and I think they overpaid for that. And so they've made some decent acquisitions, just overpaid overall, and that's my issue. Is they don't have, I think, the leadership that is going to allow them to truly compete well in the coming digital age of cloud and AI. So I'm going to say IBM should be sold, and I think there are better opportunities out there. Now, hope you tell your friends and family about our InvestTalk audio podcast being available in video form as over on our YouTube channel, and we get questions submitted over there. So let's go answer one right now. Matthew Bird says, I was wondering what your thoughts on ICLR. I own some with a cost base of 266. So the recent sell-off hurts. The company, however, is still looking like a good value. I was wondering what either of you think about picking up some more up below 200. Seems like strong support to me. All right, ICLR is the symbol. Let me pull that up here. So this is Icon PLC. It's out of Ireland. It's a provider of contract clinical research services to the pharmaceutical, biotech, and medical device industries. Here's my issue, and that is linked to the biotech space overall. Okay. When the cost of capital goes up, biotechs don't tend to do very well. It's harder for them to finance themselves. Okay. And that's a big issue in my mind. Okay. And biotechs are starting to weaken as of late, making a series of lower highs and lower lows. And you had this earnings from ICLR, which was worse than expected. Revenue is down 1% year over year, and earnings were only up 2% year over year. When a year ago, earnings were up 6%, revenue was up 6%, earnings were up 10%. So clearly a deceleration. Analyst estimates for this year and next year are coming down. And I just don't like businesses right now that are tied to biotech. So I would move on. I would sell this. I think you just learn a lesson, take your losses, and move on. Let's go take a live call and talk to Mike in Utah, looking at Royal Caribbean Group, RCL. Do you own it or looking to buy it?
So I own it. I bought it right after the pandemic. Well, a couple months after the pandemic when it was around $40, and it's up like 370%. Mm-hmm. Do you think it could still keep growing from here? Or I've been kind of getting rid of little portions of it, but it just keeps going up, and I don't want to sell it with it going up and up, So I kind of want to get your opinion on it.
Well, it's definitely in a nice solid uptrend. So the technicals are fine for now. Now, it did have pretty high volume and a decent reversal today, even though it was up. It closed kind of near the lows of the day. So something to be to keep an eye out on. Did it have earnings or anything like that today? Do you know?
What's that?
Did it have earnings or anything today? Do you know?
Earnings? No, I don't know.
Okay. Yeah, it was interesting. There's just high volume today, and I don't see any earnings announcements here. So that's of note. It is probably a good time to maybe be a bit aggressive, more aggressive on the sell, to be honest with you. But, I don't think you really want to get rid of all of it, and you have to think of the tax situation. So it's up. I think this will probably stay relatively fine through year end. Maybe something to discuss. I don't know if it's an IRA or a taxable account. Do you know?
I just own it as an individual stock, just on my own account.
Yeah. So, from a tax perspective, I want to wait until 2025 to sell a little bit more, right?
Okay.
And that's typical in going into end of a year, whether it's the broad market or particular names. If they're up, Well, it tends to stay up because of that, because people wait to take those gains until January, and vice versa. Something down, a lot of times people will be selling into year end and taking those losses. And so you're starting to get into that zone where that's probably going to matter. And like you said, it's up a lot over the past couple of years. And so I would probably wait until January, January 1st or 2nd for, first day of the trading. That might be a time where I would be more aggressive in trimming a bit, because I do think it's a bit expensive, and they do have a lot of debt in their balance sheet, and that worries me a bit. They took on a lot of debt during the pandemic, but it's profitable once again, and that's good. But it's obviously going to be very cyclical. Right now, the economy is pretty solid. You have good economic growth, but obviously that could change, geopolitical situations, et cetera. So I would probably trim in January.
Cool. Thank you. That's why we call. You have the best advice, so I appreciate it.
No problem, Mike. Thanks for the call. Thanks for tuning in.
Learn more about our services and insights by visiting InvestTalk.com.
Hi, my name's Justin from Reno. I bought a stock a few months ago. Symbol is IBRX, ImmunityBio and Company. It just pretty much doubled in price the last 5 days. I was wondering if I should add another position or if that's a bad idea, because I don't want to make a winning stock a losing stock if it goes back down. If I should wait for a pullback, or if you could look into it, let me know what you think for a long-term hold. Thank you.
All right, looking at IBRX, ImmunityBio. This went public back in 2015 at $37 per share. Quickly sank by, let's see, what date is that? 2019, down to a penny stock. It was less than $1 per share. So from mid-30s to basically zero in 5 years. Then it had, I'm assuming, some sort of report on its clinical trials, and it rallied from zero all the way to a high of $45 and change. And then that was in 2021. And then went all the way back down to $1 and change as of recently, call it late last year. And then it's been in a nice uptrend ever since, but it's still only at $6.17. Now, this is a name that's never made money, like a lot of biotech names. $4.3 billion market cap, no dividend, loses money, and they're in clinical stage immunotherapy, developing immunogenic mechanism to defeat cancer and infectious diseases. So your classic, we're going to cure cancer. How many companies have cured cancer? Well, pretty much zero. So, this is your bet that they're going to cure cancer. If they don't, well, then this is going to probably head back down to a penny stock once again. So I don't like these names. As I said with that previous caller, I don't like the biotech names, especially in a rising rate environment. I'm not sure of the news on this name. Let's see what if I can dig something up real quick on the news side. There we go. So jumps out the first patient dosed in phase 1 study for potential non-Hodgkin's lymphoma treatment. Okay, so you're talking about they gave it to one patient. I don't know if that really tells me that this is a name that is going to cure cancer. Okay, I would be selling it. I think these are the opportunities when you're in a biotech name, when they jump quickly from $3 and change all the way up to $6 and change. Like you said, it basically doubled in 3 days. These are your opportunities to sell. Now, could it go even higher tomorrow into the $8, $9, $10 range? Sure, potentially. But you want to be legging out of this name because it will reverse quickly. And when it does, you will be kicking yourself that you didn't get out. So, I'm a fundamental investor. I'm not somebody that's going to chase the story. So it's the lottery stock. You hit big, right? You put it on black, you hit, walk away from the table in my mind. Okay. Thanks for the call. Now let's touch a bit on some recent trends in corporate America. Talking about CVS, Nike, and Boeing all recently got rid of their CEOs, and they hired not young up-and-coming leaders in the organization. In all these instances, they hired older veterans within the industry. Many of them were former employees, right? C-suite employees that retired, left, and now they're being poached to come back. And you're seeing this more and more. CEO departures jumped 15% between January and August from the same period last year. And the main reason for these leadership changes is economic uncertainty. At least that's what they're saying. But what's interesting is that investors often prefer someone who's been through a few economic cycles, that has some experience in this industry as the CEO or as a high-level leader. You even see that with Disney as of late. Bob Iger came back after retiring. You also had Morgan Stanley veteran James Gorman come in as chair. So a lot of boomer generation leaders coming back at the helm. So the question is this a good idea? Well, there was a study done by MIT, Sloan Management Review in 2020. And what they do is they call these boomerang CEOs. Old CEOs that came back and tried to reinvigorate, remake a company that was doing well under their previous tenure, and they left for various reasons, and then they were poached back. You think of Steve Jobs as the main one, right? He left. John Scully from IBM came in. Company faltered, and he came back and started the iPhone, and the rest is history. You also have Michael Dell coming in and out of Dell, and you also have Procter & Gamble, brought back old CEO Alan Lafley to bring back sales, and his second tenure was not very fruitful. And MIT, like I said, looked at this, and what they saw was annual stock performance of companies led by these boomerang CEOs was 10% lower on average than their first stint counterparts. So if you think that, okay, it's an old CEO that they're automatically going to return the company to glory, well, the numbers don't really say that. And oftentimes because CEOs are overconfident and they can adopt to the changes, they want to just go back to what they were doing before. And they're often stubborn and fixated on old strategies. In some ways, they exacerbate the damage that the previous CEO had put on the company. And so the long-term transformation that is often needed in these companies that are struggling is rarely, and actually, I would say rarely, is less likely than most people are handicapping for the particular company. So always look at that when you see a previous leader come back into the business. Understand their strategy. Are they doing anything different? Does the strategy make sense? Is it truly fixing the old problems, or is it just small tweaks and kind of running a playbook that they ran before, but maybe that strategy is outdated because the economy changed or demographics has changed or the industry changed, etc. So we'll see with a lot of these names. Boeing, they hired an aerospace industry veteran that is trying to bring back the safety standards, maybe because he's an industry veteran that he can do that. But don't think that these old leaders have the magic pill, because oftentimes they don't. There's another question that came in via the InvestTalk YouTube channel. Steve Davis, 4296, says, I recently purchased Newmont. Should I add to my position following the drop from disappointing earnings, or should I wait a while and see how things settle out? All right, looking at Newmont, it's a name that we do own for clients. I've owned it for a while. Bottomed back in March around $29 and change. It recently hit a high of 58 and change, and it did have earnings. And what happened was the all-in cost of production was higher than the market expected. So the stock did drop. Now it's trading around 48 and change from 49 and change. So a pretty big drop there. But overall, if gold prices are going to continue higher, Newmont is still a very well-diversified, well-run name, and we still like it. So I think that this is more of a buying opportunity than something to sell, to be honest with you. So we think this will settle out just fine in time. It's already found support here right around the 50-week moving average, which we think is a good support level. So we would be buying on this dip. Now could continue lower. Let me give you the major supports here. Fib. Yeah, so it's at some major support right here around the $47 mark. It's found support already. Now, if it consolidates here for a little bit, I'll probably head to that 45 level, 44, 45. That's the area that I think is very, very good support. This is good support. The 45 level is the very, very good support. So between now and there, I think those are the two major levels that you could pick up.
I'm 70-year-old, retired, have about 25 to 30% in cash and bonds. And considering the current state of the economy, is it worth considering getting out of bonds and going into value stocks, more into value stocks? Thanks for all you do. Bye-bye.
Well, I think in general, the answer is yes, because in an inflationary environment, which we think we are in, stocks, especially value stocks, which tend to include a lot of harder assets like material stocks, energy, commodities, even in inflationary environments, bank stocks and financials tend to do well. So industrials tend to do well. So yes, in general, the answer is yes. Now, everyone's different. You said you have 20% of your portfolio in that. I mean, that's not a ton. So for a retiree, it's kind of more of a discussion. These are things that we do on our portfolio reviews to kind of see where you're at. I don't have a full picture of goals and cash flows and expenses, and that would be much more helpful. But in general, the answer is yes. Okay. So I like what you're thinking, and but it's a matter of the right value stocks, not just any of them. Now let's keep things moving and roll 2 in a row.
I've been looking at the stock to purchase here. Its ticker symbol is GGG, 3 Gs. It seems like it's an industrial company. From what I've researched on it, it's a quality company. Looks to be something that'll be around forever. I would love to get your feedback on it, please, and I'm considering adding it to my portfolio. Thank you for your help and your time. I love your show. Thanks for everything, you guys. Have a good day.
All right. You're looking at Graco Industry Incorporated. GGG is a symbol. It's actually a name we own in our cover call strategy. And they manufacture equipment used for managing fluids, coating, adhesives, and specializing in difficult to handle materials. So it is a almost $14 billion market cap. And you're right, it is a very good business. Return on invested capital is 20%. Same with return on equity. They have net cash on their balance sheet. And enterprise value to EBIT is at about 19, which is near the longer term average over the last 10, 20 years or so. So it's not super cheap, but it's also not expensive either. It's just a very, very quality business. Nice dividend yield, 1.25% dividend yield. Now, a lot of people won't think that's too low, but as I've always said, don't just focus on the dividend, focus on the quality of the business. And this has a very quality business. Now, the technicals are a bit neutral at the current time, but overall, we like to own great businesses like Graco at reasonable prices, and that's where we're at right now. So that was GGG, Graco Inc. Now let's keep things moving and go with 3 in a row from 888, 99 chart.
Hi, I just got a quick question about Rambus or RMBS. Wanted to see what your take is on that stock. Thank you very much. Love your show.
All right, Rambus. This is a name that's been around forever. This is one of the, if you go back, let me pull up a longer term chart on this. This is one of those .com names. Always interesting. Where it peaked out, in 2000, it peaked out around $126 per share and then never really recovered. Recently, it got as high as $75 per share, 76. But now it's been in a downtrend over the past few weeks for a few months, and it's just in a downtrend. I was just technically, I don't say it's broken, but it's in a downtrend, and I don't want to touch that. I don't want to get in front of that falling knife, because this is a name historically that is up and down. They design interface, memory, and security and display architecture for computing, gaming, and graphics. Okay, so it's a semiconductor company. And we know historically semiconductor companies are very, very volatile when it comes to their business. And Rambus is no different. And their free cash flow has come off their all-time highs. Now, they are pretty profitable right now. Return on equity is around 23%. But if I look over the last 10 years, it was pre-pandemic, it was in negative territory, 2018, 2019, and then it just recently went very profitable. So I don't like the trends in the chart. I don't like the historical volatility of the name. And so I'm actually going to pass on Rambus, RMBS. Enhance your investment knowledge. Subscribe to the KPP Premium Newsletter for access to exclusive content and expert advice. Let's go tackle another YouTube question, and it's from Blackberry7. Says, I've been thinking a while to invest in water. I have a very small position, YORW, York Water Company, but I have a few general questions regarding to utility companies. You mentioned on your podcast that they usually carry a lot of debt. How much debt is too much in a utility company? If they have so much debt, why are most of them paying dividends instead of paying off some of the debt? I understand the difference between bad debt and good debt, but for some utility companies, debt is not well covered by operating cash flow, so I don't really understand why paying a dividend makes more sense than paying back the debt. Related to YORW, do you think it's a good idea to add in my position, or should I look for a better option? A great question. How much is the reason that a lot of utility companies can handle a lot of debt is because they have very consistent businesses, because they are often regulated, which means that they are allowed to earn a certain amount of profit. It's usually not high profit. Return on equity here on YORW is 10%. It's actually on the higher end of a lot of utility companies. But if their cost of debt is lower than that, then it actually makes more sense for them to keep a little bit of that debt on their balance sheet, and knowing that, hey, their revenues and their profits are going to fall off, so they can afford that debt almost no matter what. So, but that also makes them more susceptible to rising rates. They're also bond proxies, so that also hurts kind of twofold. So it kind of depends on the utility company, but that's why they carry a lot of debt. And you're right, if they are not producing enough cash flow, not managed well enough, then they probably shouldn't be paying very high dividend. And York W is actually one of those, right? The only 2.3% dividend yield here. It's a small name, only a $500 million market cap. And it's a utility that covers York County, Pennsylvania. So 54 municipalities in that county. So that's why it's very small. It's been in a downtrend. It's been underperforming the utility sector. Now, that makes sense because a lot of the utility sector is doing well because of the electric utilities, because of expected rising demand for electricity. Obviously, water doesn't cover that. So my answer here is I just don't really see this as a bond proxy. They have a good amount of debt. It's too small, I think, for the proper scale. They don't have great cash flow. There's just so many better utilities out there. And I would just move on and find a utility that's performing better and has, is bigger, and that can spread its costs among a lot more states and municipalities. Okay. Now, lastly, let's touch on hard versus soft landing. Sorry, not hard. Soft versus no landing. There we go. And there's debates now. It used to be hard landing versus soft landing. Now it's soft landing or no landing at all. Okay, now soft landing, growth slows, but recession is avoided, while inflation returns to low and stable levels. That's a soft landing. Okay. A no landing scenario is growth just continues to accelerate, and inflation becomes more volatile and could even become an outright problem. Now, in a no landing scenario, the Fed has to keep the policy rates high. This cutting cycle will be cut short, and that will squeeze rate sensitive industries like utilities, like long duration bonds. Anything long duration is going to hurt. And sectors that are inflation hedges typically do well. The value side of the market, like we talked about earlier, will do better. And the data is starting to show that, a no landing scenario is actually becoming more likely. The latest Bank of America Fund Manager survey, the odds of a no landing doubled from 7% in September to 14% in October. And there's a few reasons for that. The September jobs number was stronger than expected. The September retail sales report showed 5% annualized growth. And which means that the 3-year average rate is now higher than the 6-year average, 6-month average rate, and higher than the 12-month average rate. That isn't an uptrend. That is an acceleration in retail sales. And then you look at bank earnings. JP Morgan CFO said spending patterns are solid and consistent with the narrative that the consumer is on solid footing and consistent with a strong labor market. He sees activity very similar to 2016 to 2019 when the economy was growing. And this is kind of goes back to what I've been saying for a while now, is the consumer balance sheet is strong, especially for those people that have some assets, stocks, real estate, etc. And wages grew at a 4% clip and have not slowed since April. So the data is starting to, and then on the inflation front, the inflation is starting to stabilize, not at 2, but closer to 3%. And so all of that leads us to believe that this is more likely a no landing scenario as opposed to a soft landing. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play, and be sure to rate on iTunes as well. Remember that we can help you better understand your portfolio dynamics and calculate your investor risk number by heading over to investtalk.com and clicking on the portfolio review button. This is a free and confidential service. This is InvestTalk Independent Thinking, shared success. Good night.